Good morning, ladies and gentlemen. Welcome to our webinar today. We are more than grateful to have you in our first webinar for the year 2021. And for the year 2023, I'm 2 years behind. Before we proceed, I would just like to lead all of us with a word of prayer. Father, in the mighty name of Jesus Christ, we thank you for this morning. We thank you for seeing us through to the year 2023. And we thank you for the audience we have and even the panelists that we have today. Father, King of Glory, we pray for your wisdom. We pray for your understanding as we go through today's webinar. And we pray that whatever information we dispatch today and those that will receive today will be able to apply it. For this we pray, trusting and believing in Jesus' name. Amen. My name is Jen Lois Kimani. I'm your host for the day today. And I work with Britam Corporate Pensions as a team leader, relationship and compliance. Now, we have seen a lot about dissecting. We have seen the implications of an Nssf Act. We have seen forums that are unpacking and demystifying. But today, since we have done all the unpacking and demystifying, we would want to see how do we embrace the Nssf Act 2013. But before we get to that point, I would just like to introduce to us the panelists for the day. So we have Mr. Tilen Omondi, who is the Chief Operating Officer, Britam Life Assurance Company. Tilen, you can just wave to the audience.
Good morning, ladies and gentlemen. Welcome to the webinar.
Thank you, Tilen. We have Mr. Jackson Kiboy, the Legal Manager, Britam Life Assurance Company Limited.
Morning, everyone, and welcome to this webinar.
We also have Ms. Rosalind Maina, who is a team leader in pension operations and also a subject matter expert.
Good morning, ladies and gentlemen. You're welcome for this forum.
Finally, we have our sign language interpreter, Mr. Boniface Moreithi. He's also pinned and will be pinned throughout this session to ensure that the communication reaches out to all the masses. And as we proceed for today's session, just a few house rules. We note that all the members or everyone in attendance is muted. So you can actually raise your questions through the chat box. There will be responses throughout the meeting, and also at the end of the meeting, we will have a Q&A session. And where we are not able to handle all the questions, we will collate all the questions and respond them to you. I would not want to take much longer through this introduction, because I know there is quite a bit that is to be covered today. So I will allow Mr. Tilen Omondi to take us through the next session. Welcome, Tilen.
Thank you very much, Jen Lois, for the warm introduction. So I'm just going to take you briefly through who Britam is and our position in the market. And then we'll unpack the Nssf Act 2013 as we go along. So introducing you to our brand purpose, which has been styled as safeguarding dreams and aspirations. And our vision remains to be the leading diversified financial services provider in our chosen markets across Africa. Our mission is to provide you with financial security every step of the way. And our brand promise is that we will work with you every step of the way. Britam has a presence in 7 geographies across Africa, across the Eastern and Southern Africa region, with plans to grow into 2 more regions, or rather 2 more geographies in the near future. Our 2021 strategy is focused on providing our clients with an epic experience. And this epic experience covers our clients, it covers our employees, our partners, and speaks to the innovation that we deploy to provide our clients with customized solutions that speak to their needs. It also covers the conduct in how we treat our customers, and we endeavor to treat our customers fairly. So that is what underpins our 2021-2025 strategy as we provide the solutions. So as you can see, within financial systems, Britam has you covered all the way from life insurance, education, investments, property, our conventional general insurance, or what we call motor and auto, and health insurance solutions. Britam has a dominant position in the life insurance space. We are the leader. In the pensions business, we command a market share of 26.84%. We are number 2 in terms of gross premiums written, but that is going to change very quickly, very soon. The life assurance company that offers the long-term solutions was incorporated in 1979. But before that, what we used to call the composite insurance company was incorporated in Kenya in 1965. But Britam, the Britam brand as a whole, came into being in the year 1925. So we have quite a rich heritage. And our company that is providing you with the life insurance solutions as well as pension solutions is regulated by both the Insurance Regulatory Authority and the Retirement Benefits Authority. We have demonstrated market leadership, which is exemplified by Britam winning the Company of the Year award for 16 years consecutively, issued by the Association of Kenya Insurers. This just goes to prove that Britam has a demonstrated market leadership. So we get into the meat of why we are in this webinar today. So back to you, Jean Lois.
Thank you, Tilan, and thank you for taking us through the Britam strategy and reminding us that through the year 2021, 2025 and beyond, our customers are actually going to also have an epic experience, which is all-rounded. So we'll just go through into the Nssf Act. And I would just like to start by taking us through what are the objectives, why do we have this being introduced, and why do we feel that regardless of what Jackson will tell us after this, that it is something that we should actually think through and embrace, whether the Act is there or not. So the objectives of the Act, number 1, is to ensure that every Kenyan is provided for a basic social security for themselves and also for their dependents. The other reason is to ensure that there is increased membership coverage of the social security scheme. So we realize that the 200 that we contribute and the 200 the employer contributes, making it 400 shillings, is not sufficient. It is not a sufficient retirement plan. And therefore, the need to improve the adequacy of the benefits paid out of the scheme by the fund. So you will note that the fund is actually a Provident fund that pays a lump sum when a member attains the retirement age. So one of the objectives of the Nssf Act is to move from that situation to a situation where each employed person right now in future is able to continue earning an income all the way to retirement. The other objective is to be able to provide a full opt-out tier 2 level of contributions. And I feel maybe that's a very high technical term to use right now when we are speaking about the objectives, but that will be broken down by my colleagues and panelists today. Also, it's to bring within the scope of the Act self-employed persons to be able to access social security for themselves and their dependents. So the Act is not limited to only persons who are employed, but even those that are self-employed, such that they will be able to provide for their own social security at such a time when they attain retirement age. And finally, to operate and manage a scheme that is value adding to its members by 2 ways. Number one, ensure that the fund and its social security systems are sustainable and at the same time affordable. So it's set out to be also affordable in the long end and at the same time be adequate to a member who is contributing. At the same time, the old Provident fund, the Nssf fund that has been there all along is a Provident fund. So that would be retained and run separately while we move to the pension fund. So it would add the value to the members because we would have such a new fund that is established that would provide such a retirement benefit plan for the members at such a point when they retire. Now, why would a committee sit down and think of how, why do we need to improve on the retirement plan for members? Why do we need to improve on the social security of Kenyans? So here are just some statistics that are there and we also need to know that after retirement, after your retirement date, you're likely to live for 25 years thereafter, or even longer. And again, 10% of your income actually goes missing every month. So if you look at your expenses in a month, you will find that there's just some amount that is missing there. And the provisions that are there in the Nssf Act actually speak into 6%. So we really need to find that 10%. Where does my income go to? Again, 91% of East Africans spend more than they earn. So we are already in an era that gives us mobile loans. And so we are actually spending in any particular month or year more than we have actually earned. Again, 70% do not have an income on retirement. So that goes to say that there is quite a number that works after retirement. So it's also a statistic that we have there, that 31% of retirees would still be working after attaining the retirement age. And only 6% of retirees depend on pension, which is such a low figure. That would mean that the other percentage is either depending on relatives, family and relatives, possibly other lines of business that they have. I do not want to say donations because I've already mentioned relatives, but 6% is quite a low figure to have as members, or rather as Kenyans, who would be termed as stable and having hope between retirement and the next stage in life. Again, the RBA reports last year showed us that only 89.4% of Kenyans lack a pension scheme. So that means that currently only 11.6% of Kenyans belong to a pension scheme. And in our other forums which we have held, we have seen that members will actually opt to access such funds at such a point. So even as we look at these statistics, we need to look at that the fact that the Nssf Act 2013 is only providing that we can access funds at retirement, which would cater for our social security as at that point. So I believe the rest of the content that we will listen to will also guide us and allow us to know what do we need to do within the Nssf Act 2013, and eventually how will Britam help us cross over to that position. So, Mr. Jackson, the next few minutes, please take us through the Nssf Act 2013. Thank you.
Thank you, Jen Lois. And once again, morning to everyone who's on the call. Thank you for joining Britam. We are here to just walk you through a journey, help you unpack the act, help you appreciate what it requires of you, and also just give you some guidelines in terms of what you need to do in the next coming days We will be providing some insights that you need to consider as you walk through this journey. We will also give you some items that are happening within the law courts for your due consideration as you plan to implement this act. So we will start off by just giving you some context, what has happened from when the act was promulgated or enacted, leading up to date. So for some of you, you may be aware this act was not new. It came in 2013, that was in December. It initially had an implementation or an effective date as of 1st January 2014. That was adjusted accordingly, but obviously employers and other industry providers felt that then this act was abrupt, did not have, say, a run-off period. It was then calling upon employers to then carry a serious financial burden without any consultation. So first off, there were several suits that were actually filed in court, and key of them was the suit by the Kenya Tea Growers Association. That suit was consolidated by the Employment and Labor Court for the determination of the issues that were being raised. So from around 2014 till 2022, that matter was still before the law courts, and that was the Employment and Labor Court. So last year in September, we did then have the Employment and Labor Court render its decision, in which it found then certain provisions of that act as unconstitutional on account of lack of public participation. Now, in the normal judicial process, Nssf then did exercise its right of appeal, and it did that via the Court of Appeal. So the Court of Appeal then rendered its decision this month of February, and in which it overturned the decision of the Employment and Labor Court. That has then paved the way to what you've seen in the media, being the law is now to be implemented effective of this month. We have seen the Retirement Benefits Authority issue circulars, and also the Nssf itself guiding that implementation starts with immediate effect. That means as of the 9th of this coming month, that is March of 2023, employers will be expected to start complying and making contributions towards Nssf. Now, I want to pause there and then just perhaps for those who may not be aware, this matter has then still not been exhausted within the judicial process. The County Pension Association has then exercised the further right of appeal, and it has, as of last week, lodged an appeal at the Supreme Court. We are aware the matter is actually appearing before court today in the afternoon for purposes of issuance of directions. We will continue monitoring this space on account of it is anticipated as the appeal is being sought at the Supreme Court, the court may grant stay orders. So for all members on the call, we encourage you just be on the lookout in the media. This is a developing space. It may evolve either in the form of stay orders, or the court may decline to grant those stay orders. So as of to date, what we are advising, the law is in force. There are no stay orders. We are meant to gear towards complying with the act as it is. So we will move into what are the changes, and that is what I believe most of you are here on the call for. Now, you may be aware that the act has brought in a two-tier system or a two-level system for purposes of the contributions. Now, that two-tier system has a component that is mandatory towards what Nssf is expecting. And we say that with the regards that currently you've been remitting 200. That has been your mandatory. That is now being adjusted within the tier system in the context of one, the employer contributing 6% and the employees also contributing 6% based on the two-tier system. Briefly, we will just, by way of illustration, give you how that 6% is applied across the two-tier system. Now, as I've stated, it's mandatory. As of right now, it then means that the employer should be preparing to make that contribution towards NSSF. We know we are at the time of the month where most companies are running their payrolls. I'm sure even with different industry players such as FKE and even RBA, they're encouraging employers to actually undertake this compliance journey. So we as Britam, we are encouraging employers to comply, and also with the first tier, which are the mandatory contributions, so as to avoid penalties and just embrace the act as it is. So having stated the first tier, the second tier is now, again, if you've not then had an instance of contracting out, and contracting out here may be defined by where a scheme seeks permission from RBA to contract out to a private pension scheme. Now, that contracting out entails a process that is laid out within the Act, and we will demystify and unpack it for you in the later slides. But what is important for employers to note is that you have the right either to remit it to NSSF or to a private pension arrangement. What we as Britam are encouraging employers is to consider the tier 2 contracting out. It gives some sense of semblance to what is already existing if you're already with a private pension scheme. What will then happen for any employee is that the scheme will be maintained, one, what you have within NSSF, and two, what will be maintained under a private pension scheme. So I wish to pause there. I'll be handing it over to my colleague, Rosalind, to give us an illustration. We don't want to make this a theoretical explanation. We want you to appreciate both as an employee, trustee, and also employer, how the two-tier system operates. And what you see before your screen is the illustration. So allow me to hand it over to my colleague.
Thank you, Jackson. Good morning again, ladies and gentlemen. I promise that I'm not going to make this session very technical. So for today, we're just going to look at these at a very high level, but in the subsequent engagements that we shall have with you, we shall ensure that we address your specific needs so that you clearly we sort of like get in depth in terms of the needs that you have in respect of the employees that you have in your books. So we are going to see how the NSSF arrangement, the new NSSF arrangement is going to look like at a very high level. So the expectation is that the employee is going to be deducted contribution at 6%, and the employer in return is expected to match that contribution. So in terms of the tier 1, so these are the levels of contributions that are provided for in the Nssf Act 2013. So tier 1, 6,000 is the lower earnings limit. So for tier 1, you'd get that at 6%, which is for the employee 6% of 6,000, which gives you the 360. But then on the employer, because they have to match the employee contribution, they would remit a similar amount. So if you're getting now to tier 2, the upper limit in terms of what is expected for that level of contributions is 18,000. I think we're going to appreciate in the subsequent slides where these numbers are coming from. So for tier 2, then would be 6% of 12,000 to give you 720. Again, the employer is going to match that contribution by another 720. So in total, as far as the employee is concerned, that would be a total deduction to the NSSF of 1,080. The employer will be matching the same contribution. I know a lot of us have heard from the media about the 2,160 that we shall be contributing to the NSSF. So ideally, that is how that number is derived at. Now, just to mention that for tier 2 contributions, these can be contracted out to a private retirement benefit scheme, but we're going to take you through the process on how that should be done in the subsequent slides. So So the Nssf Act 2013, so it provides for the progression of the rates of contributions over the years. Like it defines what lower earning limit is from year 1 to the last, say the year 5. Then you also have the upper earnings limit, again, is defined in the Act, and you can make reference to that in the 3rd schedule of the Nssf Act 2013. So for the purposes of the illustrations that we shall be taking you through, so we are going to be using the annual average earning as 36,000, and this was in respect to 2013. But for the purposes of the illustrations, that's we shall be using 36,000 as the national average earnings. So what the Act provides is that for year 1, the lower earning limit is 6,000. So for the upper earning limit, assuming the national average earning limit is 36,000, then what we have in year 1 is 18,000. So now you possibly now can tie in the previous slide to this one, where we are coming from in terms of the 18,000. So going into the next year, which is year 2, so the lower earning limit again goes up to 7,000. Then the upper earning limit then would be 1 times the national average earning of 36,000. That's why we have that figure of 36,000. 3rd year again, that goes up. The national average earning again goes up by 72,000. So what you have is 36,000 multiplied by 2. So year 4, the lower earning limit is at 9,000. So on the upper earning limit, then you'd have 3 times 36,000 to give you the upper earning limit. Now year 5 going onwards, the expectation is that the lower earning limit will be as per what is defined, what is gazetted by the Cabinet Secretary. And now for the national average earnings, then that would be published by the Kenya National Bureau of Statistics. So ideally for the new NSSF arrangement, the expectation is that as we go into the future, the contributions into the new fund are actually going up. So let's have an illustration on that. And here we are assuming a salary, an employee with a salary of 100,000. And here we're just going to focus on what's the deduction on the employee. But remember again that the expectation is the employee is being deducted 6%, then the employer would match that contribution. So for year 1, so the lower earning limit is 6,000. So when you're looking at the upper earnings limit is 18,000. And remember, we are using 36,000 as the assumed national earnings for a particular year. So what you have in tier 1 amount then would be 6,000. Then for tier 2, what you have, the upper limit being 18,000, then the amount that should be used in the computation of what goes in the tier 2 contributions is 18,000, which is the upper earning limit, less the 6,000. So that's how you get to the 12,000. So for tier 1 contributions, you will have 6% of the tier 1 amount, 6,000, to give you 360. When you get to tier 2 contributions, again 6%, it should be 6% of the 12,000 to give you 720. So overall, the total contributions in this new NSSF arrangement then becomes 1,080. Going on into year 1, the lower earnings limit, as you have seen in the previous slide and as provided for in the Act, in the 3rd schedule, the lower earning limit now goes up to 7,000. So the upper earning limit is 36,000, which means then that the tier 1 amount that we shall be using in the determination of what is the tier 1 contribution then becomes 7,000. Tier 2 amount that we're going to use in the determination of tier 2 contributions then will be 29,000. So how have we arrived at the 29,000? That's 36,000, which is the upper earning limit, less 7,000 to get us to 29,000. So for tier 1 contribution, you get 6% of 7,000. It gets you to 420. Tier 2 contribution, you get 6% of 29,000. So it gives you 1,740. So in total for that year, for that particular month, then you're talking about a total deduction of 2,160. So again, going into year 3, the same would apply, year 4. And you can actually appreciate that from year 1 to year 4, the deductions on the employee and of course the employer, the cost that the employer has to meet is actually growing as the year progresses. So that is it for me. I would wish to hand it over to my colleague, Jackson.
Thank you, Rosalind. And I think we get into the meat of what it then recalls on employers, and which we had reference to in terms of contracting out in terms of tier 2. Now, I'm sure all of you may have seen what was then issued in terms of the regulations, and then the subsequent communication that came from RBA reminding employers, if you already have an existing pension arrangement with a private pension scheme, you ought to then contract out. Now, what is contracting out? Contracting out here in simple terms is taking the tier 2 contribution and not remitting them to Nssf, but remitting them to your private pension scheme. That is more so what you've been doing in the current existing arrangement, where you've been remitting some portion to Nssf, and the other portion then has been going to a private pension scheme. Now, the bit we wish to advise at this point, before we get into it, contracting out has to be approved. Contracting out is the authority to actually remit that portion of tier 2 contributions to your private scheme. Now, with the act coming into force, it means if you don't have the authority to do so, you ought to remit those contributions to Nssf. Now, what has the regulations provided? Now, it is a written application to RBA seeking to contract out. As you contract out, you're saying, I already have an existing pension arrangement. I wish to continue remitting those funds there. Now, it means that, one, you are going to have to issue a notice period, and it is 60 days with effect from that date. Means if we were to look at the month, the date of today, we are just ending February. It means if you serve then your 60 days notice, you will end up at least within the month of May. Now, that is then what is provided within the regulation. The regulations have also provided a form which is called C1. That form is what is then an employer's application seeking to contract out. Now, that application has to be accompanied by several documents, which include a resolution from the employer seeking to contract out. It will require also a resolution from the trustees seeking to contract out. It may have a list of the employees who are within that pension scheme who are being affected, and you will need to provide the reference test certificate for the scheme that you're contracting out. That means that, one, for the period that is March and April, employers, based on what is the current position as of today without any stay orders, you will need to remit your contributions to Nssf. Once the RBA approves the contracting out, you can then now transition your funds to the private pension scheme. Now, I'll want to move to the next slide, where we need to mention that RBA has 30 days to consider your application. So it means that RBA can do it earlier or just by the 29th day. That also then perhaps expands the lead period in terms of you remitting funds. So if by the calendar days, your payroll ends up by the 29th of the date where RBA has not issued the approval, it means you still need to remit those funds to Nssf. Now, we wish to then just perhaps give some comfort that within the Act, it provides for a mechanism for you to recover those funds that have been tier 2 contributions submitted to Nssf, get them back to the private scheme. So it's not lost in that as much as you're submitting to Nssf, it may mean that we just need to address that item later down the road. Now, as we state that, we're also saying that one, pension schemes cannot then just get into this process immediately. There are some considerations that also have to happen within this process. It means that one, the Act is also requiring employers and also schemes to undertake amendments of their trust deed and rules. Remember, your authority is derived from your trust deed and rules. It then means as you make these changes for Nssf, the Act is requiring you to protect the rights under Nssf, and in each case is maintain this two-tier system, make sure they are distinct, maintained that way until the person accesses the pension in the normal course of accessing the pension. That means from an employer point of view that one, undertake the amendments as you submit your form C1, that will enable you to actually begin the contracting out. Now, we as Britam are encouraging employers because that's what is even provided for. If you already have a superior arrangement as compared to Nssf, maintain what you have with your private pension scheme and continue on that basis. Now, the regulations also require us to give a notice to employees that you'll be contracting out. So those are part of the documents that you will see. Now, the second bit happens now to these pension schemes that you're contracting out. They are also being approved by RBA, and that is what is in our next slide of the reference scheme tests. Now, the reference scheme tests here is where now a pension scheme is seeking authority from the RBA to be receiving the tier 2 contributions. Now, again, the schedules and regulations speak to this item, and for trustees, this is what you'll be calling on your administrators just to make sure they provide you with a reference scheme test certificate as proof. Now, that process, as you will see, obviously comes from a position that that scheme must be already registered, meaning that it already has its RBA certificate. It also has its KRA exemption certificate. So it is an existing scheme already operating. The second portion is that that scheme will now have to give an undertaking that they will comply with the Nssf Act as it has now been amended. Again, I reference, it is the two-tier system, meaning that it must show one, what has gone as the mandatory, that has already gone to Nssf. If you're then maintaining tier 2 contributions, they are maintained that way. And as the government then makes the adjustments of the lower and upper earnings limits, you will carry forward the contribution rate on that basis. So we as Britam are undertaking this process. We will be providing our schemes, be it standalone and even for the umbrella, with this reference scheme test certificate to assist the schemes that we support in this regard. So my presentation will stop at that point. I'll hand it back to my colleague, Rosalie, now to just give you some more insights as to this issue of contracting out. I have spelled it out as it is within the regulation. Thank you.
Thank you, Jackson, for that. I think for me, I would want to start off by defining what a contracted out scheme is. And just to mention that a contracted out scheme is an occupational retirement benefit scheme, and including an umbrella retirement benefit scheme or an individual retirement benefit scheme that has been registered and approved by the authority. And here we are referring to the Retirement Benefits Authority to receive a tier 2 contributions. So for an employer who has no existing plan, so ideally, the expectation here is that one, for all the employers in Kenya, if you're not registered with Nssf, so the first requirement is for you to register as an employer. So if this is not already done. Now, for any employer again who does not have an existing private scheme arrangement and would want to have this with Britam, so for us, the expectation one is for you to appoint Britam, of course, officially that yes, this is the provider of choice, to handle the tier 2 contributions. So once we have that appointment, then the next thing that we shall do, which is going to form part of your contracting out in respect of tier 2 contributions, is that we're going to issue you with a reference scheme certificate. So this reference scheme certificate is issued by the authority once they are satisfied that the necessary documentations have been submitted to them, and that the scheme is actually passes the quality test in terms of handling of the tier 2 contributions. So the other requirement would then be that the employer is applies to the Retirement Benefits Authority to contract out of Nssf for tier 2 contributions. So once the authority is satisfied again that you meet all the requirements that have been set out, then the next thing will be the authority is going to issue you with a contracting out certificate. So once you have the contracting out certificate, that's a nod that yes, now you can remit your tier 2 contributions to Britam. Now, what is required for you who would want to join our Britam Umbrella Pension Fund? I had alluded to earlier that the first thing is that you need to appoint us to handle your tier 2 contributions. The other thing is that the employer is expected to complete a certain proposal form that will be provided by us to officially onboard you under our deposit administration fund. Then the other thing is that the employer again is expected to sign off a deed of adherence. And here, what we usually do is that we prepare these deeds of adherence and share them with you for your review and further sign offs. So that, because these are contractual documents that needs to be in place and is actually one of those key documents that are required for you to say that you're in a position now to fully contract out the tier 2 contributions. And the other thing, as part of those deeds of adherence, the other documentation that we shall provide you as Britam is that we're going to give you the Retirement Benefits Authority, the registration certificate by the authority, that is the Retirement Benefits Authority. And also, we're also giving you the exemption certificate by the Kenya Revenue Authority, as well as the reference scheme certificate. My colleague has mentioned about the reference scheme, what that is and what that entails. So ideally for you to fully contract out, then there are these other things in respect to the scheme that needs to have been completed for us to have a full opt-out from the Nssf. So the other thing, so once we have received the deeds of adherence, now officially now that that employer, the participating employer, is onboarded, and now we have you in our books for the other contributions. So once that is in place, then there is also the expectation that the employee under the participating employers will give us the personal information that they have so that you're able to keep proper and accurate records of them. And you're also able to run that scheme as is expected. So once that is done again, now the other expectation now is that now you start remitting contributions to Britam. Then you will also get the executed copy of the deeds of adherence. So as far as joining our umbrella pension fund is concerned, these are the basic requirements that are there. However, we have our teams to guide you further should you require any clarifications on these, and we can even dive on these for a clearer understanding. So what are the benefits of contracting out? So one of the things is that we're going to give you prompt support during this process. And what process am I referring to? One of the processes is the setup. For those employers who do not have a private scheme arrangement, we are looking at supporting you through the process of setting up such an arrangement with us. The other thing is that we're also going to work with you through the contracting out process. And our support does not end there. Even once we onboard you, we shall be there all the way. So the other thing that we shall do is ensure that you have been assigned a dedicated relationship manager. So this dedicated relationship manager is a pension expert and is able to address all the concerns that you may have and is able to ensure that your scheme is run in the best way possible and within the confines of the regulations, and of course ensuring that your employees, your benefits are safeguarded into that scheme. So the other thing is that for us, we offer you a guaranteed rate of return. And beyond that, we go further to ensure that we have issued you with a bonus. So our bonuses are superior and competitive in the industry. So you can be rest assured that your retirement benefits will continue to grow. And by the time you're getting to your retirement age, then you have sufficient resources to enable you live a comfortable life at retirement. And of course, avoid, like my colleague mentioned about having a dependency on donations, the relatives that we have, because you shall have sufficient retirement at the sufficient benefits for you at the end of your retirement. So the other thing that we have is a self-service digital channel. So you're able to self-service yourself on 24/7. You're able to access your account information. You're able to view what is the status of my account. This can be done. We have a customer portal that you're able to use for that. We also have that on my Britam app. So at any one point, be it weekends or any other time, you're able to access our services without any reservations. So the other thing that we are offering you is a free member awareness forum, and such as these that we are having today. And these, we usually have sort of like quarterly engagements such as this, and more engagement with the relationship managers that we have assigned to your schemes, so that at any one point you're very clear that this is you have a clearer understanding of what pension is about, how this scheme should be run, and all that, so that you ensure that the members get a comfortable retirement at the end of the day, and they're able to have a good relationship even with the employer who has set up those schemes for them. So the other thing is for us that we are very prompt in settlement of benefits. And of course, we are not saying that we are glad when you leave, but what you're saying is that when your pension benefits are due, we do ensure that you're paid those benefits in good time and even beyond your expectations. So we are also very transparent in our dealings, and hence we will be glad if you can trust us to run your pension scheme. You can trust us to handle your tier 2 contributions. Yes, we are the retirement partner of choice. Thank you. I would like to hand over this to my colleague, Lloyd.
Thank you, Rosalind. And also thank you, Jackson, for taking us through that session. I do pray and hope that we did not get lost somewhere in between the mathematics. However, the good news is that Rosalind is telling us that the Britam team is there to personally take you through such issues or questions that we would go, or rather we would have. And again, as I listened to Rosalind, she has spoken of An employer that does not have such an arrangement, or rather does not have any private scheme, and that we would help them through. And also to note that even those employers that are already in our books, those that are in our portfolio, your relationship manager will take you through the process of contracting out and offer prompt support during that process. So Rosalind, there's quite a bit on the mathematics. And I wish to go back to the slide on how we get to know how much we contribute to NSSF and how much we can contract out. If you could take us through this slide, and this final slide, and possibly from one of the questions that I have seen, if you can possibly just give an illustration. So sorry for taking you through this on short notice, an illustration in a situation where an employee does not earn 18,000 or more.
Thank you for that. We can use a salary of 10,000 for this purpose. Please just proceed to the next slide. The next one. So here we are assuming a salary of 10,000 for an employee. Again, the lower earning limit will still remain 6,000. The upper earning limit will still remain 18,000. However, when we are coming to determine the tier 1 amount, again, for a salary of 10,000, we still have the tier 1 at a capping of 6,000. So for tier 2 amount, this is a member who has a salary of 10,000. So of course, you cannot be taking away 12,000 from the account. So what you're going to have here is 10,000 now becomes the upper earning limit for that employee. So 10,000, you less 6,000 to get you to tier 2 amount as 4,000. So when you come to tier 1 contributions, so you get 6% of 6,000 to get you to 360. Tier 2 contribution now becomes 6% of 4,000 to give you 240. So the total contribution then becomes what's 360 plus
600.
Yes, now becomes 600. Now for an employee with a salary of 10,000. So anyone below the upper earning limit in year 1 of 18,000, the upper earning limit now becomes the salary of that employee. So in this case, we use 10,000. So I hope that that is clear for the members.
All right. Thank you, Rosalind. Now, maybe we can still go back to the very first slide that had the mathematical solutions. If you could take us through that slide.
Okay.
Yeah. So that now we internalize what you've just told us about an employee that earns below.
Okay.
Yeah.
All right. All right. Yeah. So again, the expectation is still that the employee is going to be deducted a contribution rate at 6%, and the employer matches that amount. So for an employee who is earning 10,000, so remember, we are looking at year 1 here, where we have the lower earnings limit at 6,000. Then for this employee, salary being at 10,000 means that the upper earning limit for year 1 is above the salary for this employee. So for tier 2, we would be looking at 10,000, which is the maximum that we can get from that employee. So in terms of tier 1 for employee, what you're going to have is 6% of 6,000 to get us to 360. And the employer will match that contribution, and also by 360. So for tier 2, we're going to have 6% again as the contribution rate, but then here we're not going to apply 12,000 because the salary for this employee is below the upper earnings limit for that employee. So we are going to be using 10,000 as the capping for year 1 for this employee. And so for us to get the tier 2 amount that you're going to use in the determination of the tier 2 contribution to NSSF, we are looking at 10,000, which is the employee salary, which is the maximum at that point, less the 6,000 to get us to 4,000. So what we get for tier 2 is 6% of 4,000 to give us 240. Now, for the employer, they are going to match that by another 240. So in total, what you're going to have, you're going to have the employee, the total deduction will be 600, and the employer is going to match that by 600. So in total, we are going to have a total contribution of 1,200.
All right. Thank you, Rosalind. There seems to be quite a bit coming from this illustration. So I believe we'll be able to also handle one-on-one so that we are also able to respond to other queries. However, I have seen a query asking what happens in year 2 for such an employee who is still earning 10,000 in year 2.
Okay. Kindly just proceed to the next. Okay, so what we're going to have in year 2. So year 2, we have the lower earnings limit being at 7,000, and here we are assuming the salary for the employee is 10,000. So the upper earnings limit for this guy, for this employee is 36,000. That is in respect to the 3rd schedule of the Nssf Act. Now, so which means that in determining what is tier 2 amount that is to be used in the determination of the tier 1 contributions, what we're going to have is that we're going to have 7,000 as the lower earning limit. Okay, now for tier 2 amount, we're going to have the difference of, remember, the employee salary is actually below the tier 2, the upper earnings limit. So we're going to have 10,000 less 7,000 to get us to 3,000. So if you're going to, if you were to go to the, kindly go to the other table. So for year 2, previous one, kindly. So for year 2, we are going to have this situation whereby we have the tier 1 at 6% of 7,000. Remember, the lower earning, the limits continue to progress as the year goes. So we have 6% of 7,000, which is going to be 420. Then for tier 2, we are going to have 6% of 3,000. So it's going to be 10,000, which is the employee, the maximum that the employees can give, less 7,000 to give us 3,000. So 6% of 3,000 to give us 180, and the employer matches the same contribution.
So 600 still.
Yeah.
All right. Thank you, Rosalind. Quite a bit about tier 1, tier 2, and the contributions bit. So I have another question, which Mr. Jackson Kiboi will take up. If I earn below 6K, do I do any contributions to NSSF, and how do I calculate that?
Okay, thank you, Generalist, for that. So in the context of the Act, we reference the 2-tier system, and from 2013, so again, our position is we are taking the Act as it was in 2013, and the schedule therein, Generalist, if you may move to the next slide, which had provided for this lower earning limit and the upper earning limit. It means if you are not then within that limit, you cannot apply that bracket for purposes of taxes. But I believe in the context of the minimum wage, we shouldn't be getting instances of people earning below that. But if they do, we still are guided by what the lower and upper limits are. So I believe that was well explained, that one, you can only apply the 6% up to that limit of the lower earning, and then you also apply the upper limit. Back to you.
All right. Thank you, Jackson. So I think we rushed through, or rather, we went back to the calculations and matters tier 1 and tier 2 and contributions based on a request to just go back to that presentation. But I would want us to go through the Q&A as the next session for now. We have quite a bit of questions that we have that have been raised on the chat box. I see some have been responded to. So I will try to sieve out what has not been responded to, so that we are able to respond to them. So someone wanted to know, so they did not leave their name. Hi, what do you mean by the old Nssf Provident scheme will be retained and run separately? My apologies for that. It will not be run separately, but the Provident Fund will be maintained, but the continuity of the contributions within the Nssf Act is going to be provided for as a pension fund. But the Provident funds that we have had before are going to continue to be maintained as a Provident fund and can be accessed upon retirement as it were before. But the new contributions under the Nssf Act are going to be received, are going to be maintained as an NSF, as a pension fund.
If I may add on that, now the Act came in 2013. It does away with the previous Act, which means one, your contributions pre-2013 or up to, if we use it now, because now the law is being enforced in 2023, anything that was pre-February 2023 is maintained on the basis as it was, because the law had provided for it as it was, which means your contributions to Nssf, which were in the form of then Provident, will need to be maintained or preserved in that nature until you access. Now, with the transition now into the 2023, which is now post February 2023 or starting March 2023, it will be run on a pension basis, with the expectation that one, Nssf should account for what was the pre-February 2023 contributions, and two, the post that is being March 2023 contributions until you retire. I hope that gives some clarity to the question.
All right, thank you for that, Jackson. Another question, 89.4% plus 6% leaves a gap. Now, 89.4%, when we were talking about the statistics, refers to employees right now, or rather the working nation right now, that does not belong to any pension scheme today. 6% refers to retirees. This is not the working nation, so only 6% are drawing a pension, or rather are surviving from pension funds. So then the two statistics are referring to different populations. So then the gap from 89.4% is the 10.6% that does not belong to any pension plan. So I would want to take in the questions that are just coming in right now. because I think those are what have not been responded to. So there's a question again, and Jackson, you will help us through this. Would I be wrong to say that Tier 1 is a provident fund and Tier 2 is a pension fund?
Okay, thank you for that. I don't say you're wrong, but we are all in a process of adult learning, and here it is to correct misconceptions or provide clarity. Now, with that said, one, the Nssf Act provides for pension and not provident. The mandatory contributions that will be made in March going forward will be for pension, and it will be preserved that way until you retire. Secondly, it means also the Tier 2 contributions again will be within a pension fund and maintain in that form or nature until retirement. What is just happening is that what was contributed, say up to February, or the correct position would be actually January 2023, is contribution that goes towards the provident. We're having a transition. So if we say March 2023 is the transition date, it means that then Tier 1, Tier 2 will be held within a pension fund. I hope that clarifies whether being the mandatory portion to Nssf or what is then contracted out to a private scheme. Back to you, Jen Lois.
All right. Thank you, Jackson. So has Tier 2 contracting been approved?
Okay, I'll take that again. Now, contracting, as I'd referenced, has a notice period and an approval period of, so notice period, 60 days, approval period, 30 days. It means within the industry, unless a scheme had then done that in 2013 before the law was stopped, that is not then, say, approved. So which means most schemes you will find will start contracting out now that the law has come to effect. And even for RBA, they will be receiving fresh applications with that context, meaning that now we are encouraging employers, trustees, and even you as a pension scheme member to task the trustees to make sure that, one, the schemes are contracted out and have reference tests. So it's that we are found at a position where the law has changed and the transition begins now. So I believe that just gives some clarity and color to that issue. Schemes have not yet contracted and they do not have the contracting out certificates as we speak. Back to you, Jen Lois.
All right. Thank you, Jackson. I'm still scrolling to see the new queries that have come in and have not been responded to. And the question is on taxation. Rosalind, you will guide us on matters taxation. So on how does this affect the pay maximum contribution of 20,000?
Okay. Thank you, Jane Lois, for that. I think before I get into responding to that question, I probably want to make just to highlight something on the access of funds in the new Nssf arrangement. So for the old Provident Fund, that is the new, the old Nssf contributions that the contributions that we made to Nssf prior to February 2023, those ones are held in a Provident Fund, which means that at retirement, you get a lump sum out of that fund. Now, in respect of the new Nssf, so there are two provisions. The new act brought into place two types of funds. So we have the pension fund, which you have laid focus on here. So what the pension fund provides for, ideally, for anyone who is who is an employer or any person who is subject to the Employment Act ideally would fall here. So at the point of access of benefits, what happens is for any contributions into NSSF, the new NSSF, what happens is that retirement, you're only able to access these benefits, whether the benefits are contracted out into a private scheme or with NSSF, you're only able to access these benefits at retirement. So that deviates from what we have in the private arrangements, whereby someone can access part of the funds as provided for in the regulations as before retirement. Now, so the balance of the funds for any funds referenced by the Act would purchase you a pension from a registered insurer like Britam. Now we have a Provident fund that they have set up for anyone who is self-employed. So here, what we have are voluntary contributions. And this fund is a Provident, which means at the point of you retiring, then what you're going to get is a lump sum. But when it's pension, that has to wait until it's retirement, and you're not going to get the whole benefit as a lump sum, but rather you're going to get part of that benefit as a lump sum, and the balance you purchase a pension that is to pay you periodically for the rest of your life. Now, in terms of tax exemption, so we still have the tax-free amount up until 20,000. That is, these would include any contributions that you're making to your private scheme, any contributions to NSSF, should for any amount, if those aggregated figures get to 20,000, then the whole amount is tax-free at payroll. Then anything in excess of 20,000 then is taxed.
All right, thank you, Rosalind, for that response. There's a question on, is it okay if employer terms are better than NSSF to remit to the scheme net of NSSF Tier 2? So the question is, if today my employer is actually contributing more than 2,160, not my employer contribution, an employer contribution, whether it is okay to remit to a separate scheme, or rather to the employer scheme. Yes, and actually that's what you should do. You should actually continue remitting that amount to your employer's setup scheme. And it is not there in the Act, but we are calling it quote unquote, because it is not in the Act, Tier 3 contribution, but it is not in the Act. But such an additional voluntary contribution can go to your employer's scheme. There was a question which I believe speaks for many on the explanation between a provident fund and a pension fund. We seemed to have walked through and assumed that we all understand the two terms, a provident fund and a pension fund. So it has been responded to on chat, but I felt it would be important to just voice it and mention that when you're in a provident fund, what it means is that upon attaining your retirement age, you can access the accumulated benefits 100% upon attaining retirement age. If you're in a pension fund, what it means is that upon attaining retirement age, you can only access a third of the accumulated fund, and 2/3 is utilized to purchase an annuity or a pension, which should give you, or any other of the available post-retirement products that are available in the market. So that's either an annuity or an IDD, which gives you an income for the rest of your life. So that's the main difference between a provident fund and a pension fund. And what the Nssf Act 2013 is providing for or advocating for is a pension fund. or rather is access of a third and 2/3 to be utilized upon attaining retirement age. There is another question which I believe Jackson will take us through. What happens in case of death before retirement? What will be given to the beneficiaries?
Okay, I'll try and answer it in two scenarios. The first scenario being, one, remember there is what is within NSSF, and two, there is what is within your current private pension scheme. And now, in the normal course of events, one, at the time of death, obviously, the beneficiaries will notify the trustees for the private pension scheme. The scheme will then notify the beneficiary of documentations that are required to support that claim for death. The trustees will then assess who are the beneficiaries based on the nomination form and make that payment to the beneficiaries. Separately, the beneficiaries will again have to go to NSSF and seek to access the benefits under NSSF. Again, it will be on the basis of nominations, and if they are not, then it would be then for NSSF to guide as to who will then access the benefits. So it is, I don't want to call it a tool system process, but you have to go to what is what was contributed to NSSF, and you then have to go to what was contributed to the pension scheme. Jen Lois, I believe I've provided an explanation to that.
Yes, Jackson, thank you. We are trying to read all the questions in the Q&A section. There are quite a bit, but we will try to respond to as much as possible and as much as time allows, and still notice that we have sufficient time to respond to all the questions. There's a question on, is there a limit to the pension benefit paid after retirement? If I retire at age 60 and live to be 120 years, does the pension fund pay to the end, or is there an age cap? Mr. Tillen, you can guide us on that. And as you respond to that, if you can just give us a little clarity on the pension and annuity, because I used the words interchangeably. So there is a request separately to explain to that. Thank you.
All right, thank you, Jen Lois. I think Jen has picked me to respond to this because of my other hat as an actuary. So there are two types of pension schemes. So we have what we call a defined benefits pensions arrangement, and then we have what we call a defined contribution pensions arrangement. For defined benefits pensions arrangement, and for some of us who may be aware, most employers are moving away from the defined benefits pensions arrangements, including the government of Kenya. What a defined benefits pension scheme does is that it guarantees you a certain level of income post your retirement as long as you are alive. So for defined benefit schemes, for the most part, there is no cap on the age at which you stop receiving benefits. As long as you're alive, depending on the rules specified in the trust deed and rules of that particular defined benefit scheme, then you receive benefits as long as you're alive according to the rules of that scheme. For the most part, most employers are moving to the defined contribution arrangements, including what we are seeing in the new Nssf Act 2013, where Nssf is ring-fencing previous contributions to the Provident fund, and then the contributions post the enactment of the 2013 Act are being taken to a new pensions, rather a pensions fund, which basically just means 2/3 of whatever is saved by the age of retirement is being used to provide a retirement income. So for retirement, for defined contribution schemes, what it means for the pension scheme is that the amounts contributed and accumulated up to the retirement age can be used to do either of two things, or rather to buy either of two products. The first product is what we call an annuity contract. So we typically, in technical jargon, we say the scheme will de-risk, or they will transfer that risk to an insurance provider. What it means is that at the age of retirement, your defined contribution scheme will use the total amounts accumulated or saved and accumulated and use it to buy either a retirement annuity or what we call an income drawdown product. Now, the difference between an annuity and an income drawdown product is as follows. An annuity guarantees you an income as long as you're alive. There are few bells and whistles that go into that particular product, but as long as, for the most part, as long as you're alive, you get an income that has been purchased by the amounts which are accumulated by your retirement age. So an insurance company takes on the risk that you live a very long and rich life. So if you happen to live to be 150 years, the insurance company bears that risk that you live to be 150 years or 180 years. So the retirement company takes, or rather the insurance company takes that risk on your behalf. An annuity drawdown, sorry, an income drawdown product, on the other hand, allows you to exercise some discretion on how much income you want to receive and how fast you want to receive it. Now, when you're given that flexibility to determine within some stated bounds, or as per the RBA regulations, you can choose, you can vary. So you can literally determine how long you want to take an income out of that product. So what it then means is that you as a client are taking on the risk that you live to a very long age, and therefore the risk that you can actually run out of money. So you take on that risk as a client. You also take on investment risk. So there are two key risks related to the income drawdown product. One, that the investment markets do not do well or do not perform as expected. Two, that you live longer than expected. Remember, in the earlier part of the presentation, Jen Lois stated that at the age of retirement, at age 60, the normal retirement age, for the most part, the expectation is that people live for another 25 years. Now, that is an average number. Some of us might live slightly shorter than that. Some of us will live longer than that post-retirement. So there's that bit of the risk of, how long do you expect to live? The advice that actuaries normally give, actuaries and underwriters, is that if you think you might not live as long, then you're advised to take the income drawdown product, so that then you sort of enjoy as much of your retirement savings as possible before you exit. I think let's leave it at that. On the other hand, if you are in relatively good health and you suspect you might live to a very rich and ripe age, then we advise you to take an annuity contract, because then that annuity contract, it removes all those risks from you. The insurance company will bear them on your behalf. So those are the two products which are available at the point when you do retire. Thank you. Back to you, Jen Lois.
Thank you, Tilen. Jackson and Rosalind, I think we might need to go back to contracting out. There are quite a bit of questions on at this point where I already have my employer providing for me a scheme that say provides 6% or even 10% of my basic salary, and the employer matches that. Do I really still need to contribute to Tier 2 contributions? So I might need to go back to that section of the presentation.
In fact, just move to the next slide. I think it's best as we give an illustration. The next slide. So in terms of contracting out, which we just want to perhaps give our thoughts on it, is that, remember, Britam here is offering you an easy way to, where as and when you're seeking to access your pension, an easy way to access your money, get relevant financial advice as and when you're getting to that age. Now, at this point in time, we just want to restate that, remember, tier 1 is what must go to Nssf. Tier 2 need not go to Nssf. And if your employer in that context elects to contribute to a private scheme, you as a participating member, you will end up even being contracted out. I don't think there's an anticipation where someone can say, I do not want to follow the fortunes of my employer when contracting out. Now, there are reasons why an employer may choose to do that, and I'll leave that to Rosalind to provide, but here we are explaining that, one, contracting out is the easier route. It will be maintained by companies such as Britam, who will provide both support to you and the scheme towards the entire of your working life, and even at the point of retirement. So perhaps I'll leave it to Rosalind to add on why it is better to opt out or contract out as it is. Thank you.
Thank you, Jackson.
Thank you. Before you go, Rosalind,
Okay.
even as you respond to that, talking to, can I fail to opt out to this tier 2 and just continue contributing to my employer scheme or to the provided, or as an employer, can I just continue contributing into a scheme where I'm a participating employer in an umbrella or a scheme that I have set up? Is it mandatory for me to contract out with the Nssf tier 2 contributions?
Okay, thank you for that. Thank you for that, Lois. I read a lot of concerns from our audience, and this is in respect to this new Nssf Act. Please do not be worried. We shall walk with you through this journey. You do not have to feel alone. We're going to ensure that we get to that point where we get to the real details, so that you're clear on the expectations, and so that even for all of you, you're able to comply. So what are some of those benefits? Why is it important to opt out? And I alluded to this earlier, that one of the things that we, Britam, are going to do is that we're going to remove the worries that you have. So one of the worries that you have right now is there are those gray areas that are still unclear for you as far as this act is concerned, but we shall ensure that we provide that support. We shall ensure that even in the running, even for those who will be setting up a pension scheme with us, that they are able to understand the nitty-gritties of running a pension scheme to the extent that they can confidently be the ambassadors to the members who enroll into those schemes, in terms of getting to encourage them to be able to contribute more towards these, because then it alleviates poverty for them at retirement. So the other thing for us is that we'll give you an expert to be able to walk with you this journey. So you shall not be dealing with say someone who is not privy to the changes in regulations like the one that we have in place. You're going to have someone who is all-rounded, someone who is able to take you through, someone who is able to help you make that decision that is very critical in the running of the schemes. So the other thing that for us, we have always done, even for our members, is that we give our members a superior and competitive rate of return, industry-wise, and as well ensure that we have a guaranteed rate of return that members earn on their benefits. So the other thing for us, again, is that you are able to self-service. You do not have to visit our offices to get services, but you can actually be able to access service on our digital platforms. We have the customer portal, and we also have my Britam app, which you can run on your mobile. Again, we have a lot of engagement with our customers just to bring them to speed on any changes in regulations, any changes in respect to their scheme. We also advise them in terms of how do we get to that level where a member at retirement has optimal benefits that can take them through post-retirement. So we have many of such engagements with our customers just to ensure that we are together in these matters. We are not leaving them behind, that we are bringing them up to speed. And so we have to ensure that we have these awareness forums where we invite you members. So we run them both virtually, like we are doing for today, and also physically. And these, again, will depend on the client need. So the other thing for us is we settle pension benefits within the turnaround times that we have agreed on with our customers, and even surpass that by ensuring that our customers receive these benefits way before even the turnaround times lapses. So the other thing is that we are very transparent, and here, if it comes to your benefits, we have always ensured that you get your pension statements that ideally gives you an indication of where are you as a member, where are you as an employer. We'll also disclose any other things that pertains to the scheme. You shall get scheme books, you shall get the scheme rules, which is contained in the trust deed and rules. So ideally, everything that happens to this pension scheme that you set up is an open book where you can easily access information so that it's not just one party holding that information. So that is in respect of why it is important to opt out. And of course, set up a pension scheme for those employers who do not have pension schemes currently, and even stay with us for the employers that we already have in our books. So the other question was about, can one fail to contract out? Was that the question?
Yes, must I, if I'm doing 6%
Yes,
already,
yes.
must I still contract out? Like, can I still continue contributing maybe to a scheme that is set up and within Britam, or maybe I'm in a participating employer and decide I do not wish to opt out?
All right. I know that's a concern for many, and more especially because I think possibly the private arrangements that employers have are offering superior benefits. And so that is a major concern. So do you have an option not to, ideally, I would just like to simplify, do you have an option not to contribute to the Nssf? And so for my answer here, it is a no. That as long as you have not contracted out, you do not have an option but to ensure that the contributions provided for in the Act are remitted to Nssf. Remember, this is a compliance matter, and so we all as employers need to adhere to it. So we are encouraging our employers that we need to adhere to the law, because again, you see, if you don't adhere to the law, then you will be in breach and there will be penalties that may accrue to you. And of course, we don't want to get you there. And that is why we are here today. And we shall be there even after today to ensure that we assist you through that process so that you're able to comply.
All right, thank you, Rosalind. We are running out of time. So I will take only 3 questions, which have already been submitted on the Q&A section. And the 3 questions, Mr. Chila Nomundi, I will ask that you respond to them. So the first question is, kindly tackle again the query on those earning below the lower earning limit. So someone is earning below 6,000. Will you still contribute the 6% or are you exempt? As it seems, one will still have the 6% contribution. So once you respond to that, I will read the other two questions.
All right, thanks, Jen Lois. So very quickly, the amount of money that an employee earns, we cannot dictate. Of course, Jackson pointed to the need to reference the minimum wage regulation in force. But for practicality, we do know that there are people earning below the minimum. So in this case, somebody is earning below 6,000. So in that case, the percentages are not changing. So it is 6% employee and 6% employer. So if, for example, the person is earning 5,000, then we will calculate 6% of that 5,000. So it is the amount which can vary, but the percentages are not changing.
All right, thank you. So if I'm earning 4,000, my contribution will remain tier 1, and I will be doing 6% of 4,000, and it needs to be remitted to Nssf on a monthly basis. So if you're earning below the lower earnings limit, then there's no amount that goes to tier 2, but the tier 1 amount needs to be submitted at 6% of your basic salary. The other question is, what happens where employers currently contributing to an existing scheme at 5% of gross, say like 2K maximum contribution from employer, and now Nssf requires 6% from both employer and employee?
So thanks, Jen Lois. Again, this speaks to the first or rather the previous question. So the percentages are expected to be 6%. So 6% employee, 6% employer. So if the employer is contributing 5% now, then of course that means it needs to go up to at least 6%. So you're allowed to contribute more than 6%, but 6% is fixed by law. So to the extent that it's below 6%, then it needs to be increased to 6%. So the only numbers which are supposed to vary are what an employee is actually earning, which, as pointed out previously, will be graduated over time. So what we are calling the lower earning limit and the upper earning limit, they'll be increasing over time. So those ones will of course vary over time. The amount that an employee actually earns will vary. Some of it is below minimum wage, some of it is above. And as previously explained, the percentages of contribution are fixed. So we just apply them to the amounts that are there. So if the percentage is 5% of gross, then clearly it needs to be increased to 6%.
All right, thank you, Tilan. And finally, a subject matter expert, annuities and income drawdown. Can I have both?
So very quickly, thanks, Jen Lois. Yes, you can have both, depending on how big your pot is. Typically, the regulations, the RBA regulations have what we call limits. So for example, we have what we call a trivial pensions limit. So even if you are in a pensions scheme or a pension fund, and your accumulated savings at retirement is below a certain amount, then it means practically the cost of remitting those amounts to you on a regular basis might eat into your benefit. And therefore, there are regulations that say if it's below a certain amount, then even if you are in a pension fund, you will be paid a lump sum. So the advice that we have, rule of thumb, when your accumulated savings are below a certain amount, we advise you to take an annuity product. Because when your accumulated savings are below a certain amount, then it means it is not in good order to take on mortality or longevity risk, as well as investment risk. So remember what I said, the risk that you live very long, or the risk that the investment market underperforms, as we have seen in the recent past where our equity markets are not performing as expected. A property market is not performing as expected, and so on. So those risks, if your contributions are below a certain amount, we advise you not to take those risks, and therefore we advise you to take an annuity product. But where you have a sufficiently large savings pot, then we advise you, depending on circumstances, to be advised by a financial advisor who is sufficiently competent. You can consider the income drawdown product. If you have a sufficiently large pot, then nobody stops you from having both products.
All right. Thank you, Tilan. We would like to take all your questions, but unfortunately, we seem to have run out of time. And definitely, as we have mentioned, Britam is there to take you through if you're not in any private or any other organized scheme. If you're in any of the schemes that we manage, your relationship manager will be there to take you through. You just need to reach out to the relationship manager, and they'll be there to take you through, either as a group or as an individual. So I wish to thank all of us for taking our time to attend to this webinar today. And also wish to note that it's not the last of the webinars, it's actually the first of the webinars that we will have on the Nssf Act. And we shall have very many other interactive sessions between now and December of 2023 and even beyond. So we will continue to interact and continue with this discussion offsite, and each time that there needs to be an update, we'll also ensure that we are there to update you. And to the panelists today, thank you. I believe that you have shared the information as much as possible. And if any of the audience reaches out to us, we are still able to give them responses. So thank you, Tilan. Thank you, Jackson. And thank you, Rosalind. Thank you, Boniface, our sign language interpreter, for continually ensuring that all the time we have our webinars that we are communicating to all the audience that we invite. So I wish to mark this webinar for today as closed. And before then, I will request Rosalind to lead us with a word of prayer.
Thank you, Jen Lois. Let us bow our heads for a word of prayer. Almighty God, we come before you this morning. We thank you for allowing us to participate in this forum and see the end of it. And thank you for our attendees. May you guide us in ensuring that that we better the retirement for our employees, that even as we continue to break down these new regulation, that you may be with us. We thank you and we give you praise. In Jesus' name we pray. Amen.
Amen. Thank you.